Hello everyone, welcome to my channel where I talk about personal finance. Today, I'm going to talk about keep investing in the stock market even though it's down. Let's get into the video. It's tempting to question yourself or your financial advisor if you have one. Should I pull my money out of the stock market? When the stock market falls and the value of your portfolio plummets, that's understood, but it is probably not the best option. Instead, consider asking yourself, what should I not do? The solution is simple. Do not be alarmed. When stocks are falling and the value of people's portfolio is plummeting, panic selling is a common reaction. As a result, it's critical to understand your risk tolerance and how price fluctuates or volatility will affect you ahead of time. Hedging your portfolio through diversification, holding a variety of investments, including some that have a low degree of connection with the stock market, is another way to reduce market risk. Investing helps you protect your retirement, make the most of your money, and expand your wealth through the power of compounding. So, why do most people do not invest in the stock market? One reason may be the lack of confidence in the market as a result of the 2008 financial crisis and the recent market volatility. Those who do not have enough funds to get by month also do not have money to invest in the market. It is critical to remember that the stock market is critical and that stocks will inevitably fall in value. However, a dip is only brief. Instead of panic selling when stock prices are all at time lows, it's better to look long term. Long term investors understand that the market and economy will eventually revive and they should be prepared for it. In March of 2020, when the stock market entered a bear market for the first time in 11 years due to the economic effect of the global pandemic, the S&P 500 fell by a heartbreaking 35% in just over a 4-week period. The index has not only quickly recovered from those lows, but has also set new highs multiple times since then. Instead of panicking and locking in your losses by selling at the lows during a severe market drop, device a bear market strategy to safeguard your assets. When the stock market falls, there are several actions you can take to ensure you do not make the number one mistake. Investors are likely to recall their first experience with a market correction. A fast fall in the value of an investor's portfolio is disturbing to say the least for inexperienced investors. That is why it is critical to determine your risk tolerance before you begin constructing your portfolio, rather than when the market is in its midst of a sell off. Your risk tolerance is determined by a variety of factors, including your investment time horizon, monetary needs, and emotional reaction to losses. It's usually determined by your responses to a questionnaire. Many financial websites offer free online quizzes to help you determine your risk tolerance. Your risk tolerance is mostly determined by your investment time horizon. A retiree or someone approaching retirement, for example, would generally desire to protect funds while also generating income in retirement. Low volatility stocks or a portfolio of bonds and other fixed income instruments might be appropriate for such investors. Younger investors, on the other hand, may choose to invest for long term growth because they have many years to make up for any losses incurred during down markets. You must understand how the stock market operates in order to invest with clarity. This allows you to assess unforeseen market downturns and determine whether to sell or acquire more. Finally, you should be prepared for the worst case scenario and have a strong strategy in place to mitigate your losses. If the market crashes, investing just in equities could result in a large loss of capital. Investors intentionally make other investments to spread out the exposure and reduce risk in order to hedge against losses. Of course, lowering risk comes with a risk return trade off, in which lowering risk means lowering possible profits by diversifying your portfolio and employing alternative investments like real estate that have a low connection to equities. You may mitigate downside risk to a large extent. Diversification is defined as having a portion of your portfolio spread across stocks, bonds, cash, and alternative assets. Every investor's situation is unique, and how to allocate your portfolio is determined by your risk tolerance, time horizon, and goals, among other factors. You can avoid the risk of putting all your eggs in one basket with a well executed asset allocation strategy. Despite the fact that stock market returns can be fairly unpredictable in the near term, research shows that adequate outperform practically every other asset class in the long run. Even the biggest declines appear to be minor blips in the market's long-term upward trend when seen over a suitable extended period of time. This is especially important to remember during volatile periods when the market is on the downturn. With a long-term perspective, you will be able to see a major market downturn as an opportunity to develop wealth by adding to your assets, rather than a danger to wipe out your hard-earned money. During major bear markets, investors sell stocks regardless of quality, creating an opportunity to buy certain blue chips at reasonable prices and valuations. Consider dollar cost average if you're afraid that this strategy might be construed as market timing. Dollar cost averaging is a method of averaging out the cost of owning a specific investment or asset, such as an index ETF, by purchasing the same dollar amount of investment at regular intervals. The ultimate result may be a cheaper average cost for the investment because these periodically purchases will be made methodically as the asset's price fluctuates over time. Investing in the stock market at regular period, such as with each paychecks, allow you to benefit from a practical known as dollar cost averaging. Dollar cost averaging is a method of averaging out the cost of owning a certain investment by purchasing the same dollar amount at regular periods, resulting in a lower average cost for the investment. If you want to learn how to invest your money, please check out my course on how to invest your money below of the description of this video. Thanks for watching this video and do not forget to subscribe to my channel.